All right, so let's dive right in. We're going deep into today's market landscape, and we've got this really interesting AI-generated market briefing as our guide.
Yeah, it's kind of like having, a super smart market expert breaking down all the important news just for us.
Exactly. And it's amazing how technology is like changing how we get our information, even in finance.
Absolutely.
Now, the briefing has kind of a cautiously optimistic tone, like, hey, things might be a bit rough, but we got this, sort of acknowledging both the good and the bad out there.
Yeah, I get that feeling too.
So let's jump into the actual market performance. Seems like there's some uncertainty going around. The S&P and the Dow are down a bit, which, okay, not too crazy.
Right.
But the Nasdaq took a bigger hit, dropping over 0.5%. Tech weakness seems to be the culprit there. But it's not all doom and gloom. The Russell 2000 actually managed a small gain. So it's a bit of a mixed bag. What do you think these different signals are telling us?
Well, I think it shows that investors are a bit hesitant trying to figure out where the economy is going. These mixed market moves make it hard to get a clear picture. Like, is this tech slump a sign of bigger problems to come, or is it just a temporary thing?
That makes sense. It's like everyone's waiting to see what happens next before they, make any big decisions.
Yeah.
And speaking of uncertainty, the crypto world seems to be feeling it too. Bitcoin dipped below that, big $100,000 mark, and Ethereum dropped even more.
It's funny how that $100,000 number for Bitcoin always makes headlines. It's like it has this psychological effect on people.
Right.
But beyond just the headlines, I think this crypto volatility is also tied to, the bigger economic uncertainty. Investors are trying to figure out how things like inflation and potential recessions might impact these digital assets.
True. It's all connected. But now for something that could really shake things up, there's a lot of talk about Fed Governor Christopher Waller hinting at, potential interest rate cuts in 2025.
Yeah.
Possibly even starting in the first half of the year.
This is where it gets interesting. The Fed's decisions impact, well, everything.
Right.
If they do cut rates, it could help the economy grow, but it also risks making inflation worse, which is already a concern. It's a tricky balancing act they have to get right.
A tricky balancing act, for sure. And speaking of things that hit close to home, mortgage rates just went above 7% for the first time in 8 months. That's a big deal for anyone thinking about buying a house or refinancing.
Absolutely. Rising mortgage rates can really affect the housing market and even how much people spend overall. I mean, think about it. If you're suddenly paying hundreds of dollars more each month on your mortgage, you have less money to spend on other things. And that can slow the whole economy down.
It's a domino effect.
Yeah.
Now let's move to the tech sector, where there's some interesting things happening. One thing that really stood out in the briefing was Wolf Research downgrading AMD. They're worried AMD's AI business might not live up to the, high hopes that people have.
What's interesting here is that it shows that investors need to be realistic about how quickly AI will actually make money. The long-term potential of AI is huge, no doubt, but it's not a guaranteed moneymaker right now.
It's a good reality check.
Yeah.
But then, on a more positive note, we have Jeff Bezos' Blue Origin successfully launching the New Glenn rocket for its first test flight. Could this be a game changer in the space race?
It's definitely a big step. This successful test flight is a win for Blue Origin and could shake things up as they get more serious about commercial space travel. The competition between them and SpaceX is going to get even more intense, which is exciting if you're into space exploration.
It's like reaching for the stars, literally. Yeah. But let's bring things back down to Earth, shall we?
Okay.
Let's look at some other important sector trends, because as we've already seen, everything's connected in this global economy.
Absolutely. What happens in one area can ripple through everything else.
Right. So the tech sector, as we've talked about, is still facing those profitability issues and regulatory scrutiny. Meanwhile, energy seems pretty stable right now, with oil prices holding steady. But those geopolitical risks are always out there.
And those geopolitical risks are always unpredictable. Any instability in the Middle East or unexpected moves by OPEC Plus could make oil prices skyrocket and mess up the global energy market.
It's true. It reminds us that we live in a complicated world, and there are always things happening that can impact the markets.
Definitely.
Now, the financial sector is definitely keeping a close eye on those potential Fed rate cuts we mentioned earlier. Banks could face lower profits if rates drop, but it could also lead to more people borrowing money and more economic activity. It's a mixed bag for them.
It is. They're going to be carefully considering both the good and the bad.
And of course, we can't forget about the global landscape, which adds another layer of complexity.
Right.
What are we seeing on the international stage?
Well, China's recovery after the pandemic has been slower than expected, and that affects global supply chains and prices for things like, raw materials.
Yeah.
And Europe's energy problems are still a big issue, affecting energy prices and their long-term energy security.
It's like a giant economic puzzle where each piece affects all the others.
It really is. That's why it's so important to stay informed and understand how global markets work. Even if you're only interested in investing in your own country, what happens in other parts of the world can directly affect your investments.
Couldn't agree more. So, what's the big takeaway from all of this? What can we expect in the coming months based on this briefing?
While most analysts seem to think we're going to see some ups and downs in the stock markets, those possible Fed rate cuts might help. But inflation, geopolitical risks, and those sector-specific issues we discussed, those aren't going away anytime soon. It's going to be an interesting year, that's for sure.
Definitely a lot to keep an eye on. And remember, all of this came from an AI-generated report, which, adds another layer to the whole discussion. It makes you think about how technology is changing how we analyze and make decisions about finances.
It does. It brings up some interesting questions about how much we can trust AI in this complex world. Can it really replace human judgment when it comes to investing, or is it just a tool to make us better?
Great point. And that leads us perfectly into the next part of our deep dive, where we'll explore the world of behavioral economics and how our psychology affects our investment decisions. Stay with us.
It's going to be fascinating. It's pretty amazing how even with all the data and fancy algorithms we have, human psychology still plays such a big role in investing.
Totally. It's like we can't escape our own human nature, even when we're dealing with something as, seemingly logical as money.
Right.
So how do we even begin to understand this whole behavioral economics thing? What are some key concepts we should know?
Well, one of the most basic ideas is something called loss aversion. Basically, it means that the pain we feel from losing something is stronger than the pleasure we get from gaining the same amount.
So we're more driven to avoid losses than we are to, like, go after gains. Huh, interesting. How does that play out when people are actually investing?
In a lot of ways. For example, people often hold on to stocks that are losing money for way too long, hoping they'll bounce back, even when it might make more sense to just, cut their losses and move on.
It's like they're emotionally attached to those investments, even if it's hurting them financially.
Yeah.
I guess it makes sense, though. It's their hard-earned money we're talking about.
Right.
So what other psychological traps should we be aware of?
Another common one is confirmation bias. This is when people tend to look for information that supports what they already believe and ignore stuff that contradicts it.
Oh, I see that all the time, online, in forums, and on social media. People just gravitate towards sources that agree with their views, even if those views might not be, totally accurate.
Exactly. And when it comes to investing, this confirmation bias can lead to bad decisions because they're not getting the full picture. They might only pay attention to good news about a company they've invested in and ignore any warnings or negative reports.
It's like they're wearing blinders.
Yeah.
So how can we avoid falling into these traps? Is it even possible to completely get over our human nature?
It's definitely tough, but there are things we can do to minimize these biases. One important strategy is to make a clear investment plan and stick to it. Write down your goals, how much risk you're comfortable with, and your overall strategy. And then, actually refer back to it regularly. This can help you stay focused and avoid making impulsive decisions based on your emotions or, just bad thinking.
It's like having a roadmap to keep you on track even when things get a bit bumpy.
Exactly. Another good strategy is to diversify your portfolio. This not only reduces financial risk, but it can also help counterbalance some of these psychological biases. If you're not putting all your eggs in one basket, you're less likely to make emotional decisions based on fear or greed.
Makes sense. Spread the risk, both financially and emotionally. Anything else we can do to become more rational investors?
Well, one of the most effective ways to fight these biases is simply to be aware of them. The more we understand how our minds work and how we tend to fall into these traps, the better we'll be at making rational decisions.
It's like shining a light on those blind spots we all have.
Exactly. And it's a constant process. We're all human and we're all susceptible to these biases. The key is to be mindful and come up with strategies to minimize their impact on our decisions.
So self-awareness is key.
Yeah.
Got it. But let's go back to this idea of having a clear investment plan. What should that look like in practice? What are the essential elements?
Well, the first step is figuring out your financial goals. What are you hoping to achieve through investing? Are you saving for retirement, a down payment on a house, or something else? Once you have a clear picture of your goals, you can start developing a plan to reach them.
Right, it's all about knowing where you want to end up. But how do we figure out the best way to get there? There are just so many investment options out there. It can be overwhelming.
It can be. That's where research and education come in. Spend some time learning about different types of investments like stocks, bonds, and real estate. Understand how they work, the risks and potential rewards, and how they fit into your overall plan.
So it's like building up a toolkit with different investment tools for different purposes.
Precisely. And once you have a basic grasp of those options, you can start thinking about asset allocation. That means deciding what percentage of your money you'll invest in each type of asset.
Ah, asset allocation. I've heard that term thrown around, but I'm not sure I fully get it. Can you break it down for me?
Sure. Asset allocation is all about balancing risk and reward. Different types of assets have different levels of risk and potential return. For example, stocks tend to have higher potential returns than bonds, but they're also riskier.
Okay, so it's about finding the right mix of investments to match how much risk you're comfortable with and what you're trying to achieve.
Hmm.
If you're younger and have more time, you might be okay with having more of your money in stocks, while someone closer to retirement might want to be more conservative and have more in bonds.
Exactly. And your asset allocation should align with your goals. If you're saving for a short-term goal, like a down payment on a house, you'll want to focus on investments that are less volatile, even if they don't have as much potential for growth. But if you're saving for retirement, which is a long-term goal, you can take on more risk to try to get higher returns.
Gotcha. It's all starting to make sense. But how often should we be revisiting our plan and adjusting our asset allocation? Is it something we should be doing all the time, or is it more of a set it and forget it kind of thing?
I wouldn't say set it and forget it, but you don't need to be constantly changing things up either. A good rule of thumb is to review your plan at least once a year, or whenever something big changes in your finances or goals. Like if you get a big raise, get married, have a kid, or go through any other major life event, it's a good time to take another look at your plan and make sure it still makes sense for you.
Right. Life throws us curveballs, so our plans need to be flexible enough to adapt. But I imagine there's a balance between making adjustments when you need to and, overreacting to every little market wiggle. How do we find that sweet spot?
That's where discipline and patience are important. It's key to remember that investing is a long game. Short-term ups and downs are normal, and getting emotional about every change can lead to expensive mistakes.
It's about keeping your eyes on the prize and not letting the day-to-day market noise throw you off course.
Exactly. And that brings us back to why having a clear plan is so important. If you know what you're working towards and why, it's much easier to stay focused when the market gets crazy.
Okay, so we've talked about loss aversion, confirmation bias, having a plan, and asset allocation. Any other psychological factors we need to be aware of before we move on?
Oh, there are tons more, but one that's especially relevant these days with social media and the 24/7 news cycle is recency bias. That's our tendency to put more emphasis on recent events or information, even if they don't necessarily represent the bigger picture.
Oh, I see. So if the market has been doing well lately, we're more likely to be optimistic, even though past performance doesn't guarantee future results.
Right. And the opposite is true too. If the market has been struggling, we might be too pessimistic, even if there are good reasons to believe things will eventually get better.
It's like our brains are hardwired to focus on the most recent stuff, even if it's not the most important. So how do we overcome this recency bias?
One way is to actively try to take a longer view. Look at historical data, consider the overall economic situation, and don't let those short-term market swings cloud your judgment.
Zoom out and see the forest, not just the trees.
Exactly. It's about staying focused on those long-term goals and not getting distracted by the noise.
So we've covered loss aversion, confirmation bias, and recency bias. Anything else we need to watch out for before we move on?
There are a lot, but another one that often trips people up is herd mentality. This is that tendency to follow the crowd, even when it might not be the best move for us individually.
Herd mentality. Is that like when everyone rushes to buy the same stock because it's the hot new thing, even if they don't really understand the company?
Mhm.
Or when everyone panics and sells at the first sign of trouble, making prices drop even more?
Exactly. It's the fear of missing out on the one hand and the fear of getting stuck with a bad investment on the other. And it can be really powerful, especially when things are uncertain. When the market is volatile and people don't know what to do, they often look to others for guidance.
I get it. If everyone else is buying or selling, it's easy to feel like you should be doing the same, even if you don't have a good reason.
Right. It's like that old saying, if you see a crowd running, run with them. But in the investing world, that's usually the worst thing you can do.
So how do we avoid getting swept up in the herd mentality? How do we make sure we're making decisions based on our own assessment of this situation and not just blindly following everyone else?
Well, again, it comes back to having a clear plan and sticking to it. If you've done your research, you understand how much risk you're comfortable with, and you have a strategy in place, you're less likely to be swayed by what other people are doing.
It's about having the confidence to go your own way, even when everyone else is heading in a different direction.
Exactly. And it's important to be critical of the information you're getting. Just because everyone's talking about a particular stock or investment strategy doesn't mean it's right for you. Do your own research, ask questions, and don't be afraid to question the conventional wisdom.
It's about thinking for yourself and not just blindly accepting what everyone else is saying. I love that. So we've covered loss aversion, confirmation bias, recency bias, and herd mentality. Any other psychological traps we should watch out for before we wrap up this section?
We could talk about this all day, but one that's really relevant these days with social media and constant news is recency bias. That's the tendency to give more weight to recent events or information, even if they're not really representative of the bigger picture.
Oh, that makes sense. So if the market has been doing well lately, we're more likely to be optimistic, even though past performance doesn't guarantee future results.
Exactly. And the opposite is true too. If the market has been struggling, we might be too pessimistic, even if there are good reasons to believe things will eventually get better.
It's like our brains are wired to focus on the latest news, even if it's not the most important information. How can we overcome that?
Well, one way is to consciously try to take a long-term perspective. Look at historical data, consider the broader economic context, and don't let short-term market fluctuations cloud your judgment.
So it's about stepping back and seeing the bigger picture, not getting caught up in the day-to-day ups and downs.
Exactly. It's about staying focused on your long-term goals and not letting the noise of the market distract you.
Okay, so we've covered a lot of ground here when it comes to behavioral economics and how our minds can affect our investment decisions. It's fascinating, but also a little bit intimidating to realize how much our own brains can work against us, even when we have good intentions.
It is. But the good news is that by understanding these biases, we can start to minimize their impact and make smarter choices. It's like having a secret weapon in our investing toolkit.
I love that. A secret weapon for outsmarting our own brains.
So we've talked about how this works for individuals, but what about the bigger picture? How do these behavioral economics ideas play out on a larger scale, like in the whole market? That's a great question. It takes us into the world of market psychology, where individual biases can combine to create trends and patterns that affect the entire market.
Okay, I'm intrigued. Tell me more about this market psychology.
Well, imagine a lot of investors getting really optimistic about the market. Maybe there's a bunch of positive economic news, or a new technology is creating a lot of buzz. This optimism can create what we call a self-fulfilling prophecy, where those positive expectations actually drive prices up, which then creates even more optimism and attracts more investors.
So it's like this feedback loop where positive sentiment just keeps feeding itself and creates a bubble in the market.
Exactly. And we've seen this happen many times throughout history. The dot-com bubble in the late 90s is a classic example. Investors got caught up in the hype around the internet, and prices for tech stocks went way too high.
And then, of course, the bubble burst, and a lot of people lost a lot of money.
Right. But what's interesting is that even though these bubbles are often driven by, irrational excitement, they can last for a while.
So how do we know when a bubble is forming? Are there any warning signs?
There are some typical indicators. One is when prices increase really quickly, but it's not because the underlying asset is actually performing better. Like, if a company's stock price is skyrocketing, but their earnings aren't keeping up, that could be a sign of a bubble.
So it's about looking past the hype and focusing on the company's actual performance. Any other red flags we should look out for?
Another warning sign is when people are using a lot of leverage, meaning they're borrowing a lot of money to invest. This can make both gains and losses much bigger. If a lot of people are using leverage to buy into something, it can create a shaky market that's prone to a big correction.
It's like a house of cards. One little breeze and the whole thing collapses.
Exactly.
Okay, so excessive leverage, rapid price increases, and a disconnect from the fundamentals.
Yeah.
Those are all signs that a bubble might be forming. But what about the other side of the coin? What happens when the overall sentiment in the market turns negative?
Well, just like too much optimism can create bubbles, too much pessimism can lead to market crashes. When investors get scared, they sell their assets, driving prices down. And as prices fall, it can create more fear and selling, leading to a downward spiral.
It's like a self-fulfilling prophecy, but in the opposite direction. Negative sentiment feeds on itself and creates a bear market. But how do we know when fear is getting out of hand? Are there any signs that a market crash might be coming?
One indicator is a big jump in market volatility. When prices are fluctuating wildly, it often means investors are nervous and unsure of what to do.
So it's like the market is having a panic attack.
Exactly. Another warning sign is a drop in trading volume. When fewer people are buying and selling, it can indicate a lack of confidence in the market.
It's like everyone's holding their breath, waiting to see what happens next. So, high volatility, low volume, and a general sense of fear and uncertainty, those are all red flags that a crash might be on the horizon. But how do we navigate these turbulent times? How do we make good decisions when everyone else seems to be losing their cool?
Again, it goes back to having a solid plan and sticking to it. If you know what you're trying to achieve and why, you're less likely to be swayed by the emotions of the market.
It's about having that internal compass to guide you through the storm. But what if your plan is to buy stocks and the market is crashing? Isn't that a bad time to invest?
It's tempting to wait for the market to hit rock bottom before buying, but the truth is, no one knows when that will happen. Trying to time the market is one of the biggest mistakes investors make.
So what should we do instead? Just keep buying stocks even when the market is falling.
It depends on your situation and your goals. But if you're investing for the long term and you believe in the companies you're buying, market downturns can actually be a good opportunity to buy. You're basically getting those assets on sale.
It's like shopping at a clearance sale. You're getting the same thing at a lower price. But that takes guts, right? It's hard to go against the flow and buy when everyone else is selling.
It does. But remember, the market goes in cycles. What goes down will eventually come back up. And if you're thinking long term, you can use these market downturns to your advantage.
That's a great way to look at it. It's about seeing the opportunity in the chaos. But I imagine it's still important to be careful and not just throw all your money into the market without thinking, right?
Absolutely. It's crucial to do your research, understand the risks, and only invest money you can afford to lose. And don't forget about diversification. Don't put all your eggs in one basket, especially when the market is volatile.
So spread the risk, stay disciplined, and don't let emotions take over. That sounds like good advice whether the market is up or down.
It is. And it all circles back to the importance of understanding both individual and market psychology when it comes to investing. By recognizing the biases that can affect our decisions, we can become more rational investors and navigate the market with more confidence.
This has been such an insightful conversation. I feel like I've learned so much about what drives the market and how to avoid those common traps. But before we move on, I'm curious about something we touched on earlier: the role of AI in financial analysis. We've been talking about all these human biases, but what about biases in algorithms? Is that something to be worried about?
That's a great question, and it's getting more important as AI plays a bigger role in finance. Algorithms can be powerful tools for analyzing data and finding patterns, but they're not immune to bias. Since humans create algorithms, they can reflect the biases of their creators.
So if the data used to train an algorithm is biased, the algorithm will be biased too.
Exactly, and this can have real consequences. For example, an algorithm used to decide who gets a loan might unfairly discriminate against certain groups of people if the data it's trained on reflects historical patterns of discrimination.
That's a serious issue. How can we make sure the algorithms used in finance are fair and unbiased?
It's a complex problem, and there's no easy solution. But one important step is to be aware of the potential for bias and actively work to minimize it. That means carefully choosing the data used to train algorithms, testing them for bias, and being transparent about our limitations.
It's like we need to hold algorithms to the same standards of fairness and accountability as we do for humans.
Exactly, and it's a constant process. As AI technology keeps developing, we'll need to keep evaluating the potential for bias and find new ways to reduce it.
Okay, so algorithmic bias is something we need to watch out for as AI becomes more common in finance. But what about the other side of the coin? How can AI help us overcome our own human biases?
That's a really interesting question, and I think there's a lot of potential there. For example, AI can help us see patterns in our own behavior that we might not be aware of. It can also give us objective data and analysis that can help us make more rational choices.
It's like having a personal coach who can point out our weaknesses and help us improve.
Exactly. And as AI technology keeps advancing, I think we'll see even more innovative applications that can help us become better investors.
That's exciting. So it sounds like AI is both a potential problem and a potential solution when it comes to bias in finance.
It is, and it's our responsibility to make sure we're using AI responsibly and ethically to create a fairer and more equitable financial system for everyone.
Well said. This has been such an eye-opening conversation. We've covered so much, from individual psychology to market psychology to the role of AI in finance. I feel like I have a much better grasp of what makes markets tick and how to make smarter investment decisions.
It's been great exploring these topics with you.
But before we move on, I want to shift gears for a moment. We've been talking a lot about being rational and objective when we invest, but I can't help but wonder if there's also a place for intuition and gut feeling in this process. What are your thoughts?
That's a fascinating question. It's something a lot of investors struggle with. We want to make rational, data-driven decisions, but sometimes you just have a feeling about something.
Exactly. Sometimes it's just a gut feeling about a particular investment, even if we can't logically explain it.
Right. And I think intuition has a place in investing, but it's important to understand its limits. Intuition can be a powerful tool, but it can also be easily swayed by our biases and emotions.
So it's about finding that balance between intuition and rationality.
Exactly. We need to be aware of our own biases and emotions, and we need to have solid knowledge and analysis to back up our decisions. But I also think there's room to trust our gut, especially when it's based on experience and a deep understanding of the market.
I like that. It's like blending the art and science of investing. We need both the analytical skills to understand the numbers and the emotional intelligence to trust our instincts.
Precisely. And I think the most successful investors are the ones who can do both.
This conversation has been so enriching. I feel like I have a whole new perspective on investing and the interplay of psychology, markets, and technology.
It's been a pleasure diving into these ideas with you.
But before we go to our final segment, I want to leave our listeners with a question to think about. We've talked a lot about how to make better investment decisions, but I think it's just as important to consider why we're investing in the first place. What are we ultimately trying to achieve with our money? What kind of world do we want to create with our financial resources?
That's a profound question, and it's one that every investor should ask themselves. Investing isn't just about making as much money as possible. It's about making sure our financial decisions align with our values and using our money to make a positive impact.
Beautifully said. And that leads us perfectly into our final segment where we'll explore the connection between finance and sustainability. Stay tuned.
It's really becoming clear that, we can't talk about the future of finance without talking about sustainability.
Absolutely. And I think a lot of people might see those two ideas, like finance and sustainability, as kind of opposites.
Yeah, I can see why. For a long time, finance was all about, making as much profit as possible, even if it meant, not really caring about the impact on society or the environment. But I think things are changing.
So how are we seeing that change happening in the real world? What does, like, sustainable finance actually look like?
Well, it can take different forms. One example is impact investing. That's where investors specifically look for companies and projects that are trying to solve social or environmental problems. It's about using your money to make a positive difference while also, getting a financial return.
So it's not just about, like, avoiding doing harm. It's about actually trying to do good.
Exactly. Another growing trend is ESG investing. ESG stands for environmental, social, and governance. ESG investors consider how a company performs on those factors, alongside the usual financial stuff, when making their decisions.
So it's about looking beyond just the numbers and thinking about the bigger impact of a company's actions.
Exactly. And there's more and more evidence showing that companies that do well on ESG stuff are also more successful financially in the long run.
That's really interesting. So it's not necessarily a choice between doing good and making money. You can actually do both.
Right. And I think that's a really important message. It's not about giving up returns. It's about understanding that sustainability is actually key to creating value over the long term.
That makes sense. But how do you actually measure a company's ESG performance? It seems like a pretty subjective thing.
It can be, but there are more and more organizations out there that are providing ESG ratings and data. They look at stuff like a company's carbon emissions, how they treat their workers, the diversity of their board, and their commitment to ethical business practices.
So it's about being transparent and accountable. Companies need to be able to show that they're committed to sustainability in a way that can be measured and verified.
Absolutely.
Yeah.
And I think this need for transparency is only going to get stronger as more investors focus on ESG factors.
That's a good thing. But what about the role of government and regulations in all of this? Do we need to see more of that to really promote sustainable finance?
I think it's crucial.